Hi everyone, this is Bill Cantor with Complete Estate and Retirement Planning in Skokie, Illinois. I'm an attorney and financial planner, and today I'm going to do this video about income riders or retirement income, how to increase the income on your retirement accounts and using the income rider, which, as it says here, an income rider, also called an income annuity, is a rider attached or added to an equity indexed annuity contract. The rider guarantees a set return, in our example 8% compounded per year. That's probably the best income rider currently, but it's credited to an income only account. It's very crucial we understand what I mean when I say income only account. We're going to talk about that. That income only account which will provide guaranteed income for life. So first thing is to again understand that this is a rider attached to an equity indexed annuity contract. So this is how an equity indexed annuity contract works. The basic contract, not the rider. This is how the basic contract works. This is a graph put out by the American Equity Insurance Company. They issue one of the largest issuers of equity index annuities. This is the S&P. The red line here is the S&P, and the blue line is the annuity. So you see the annuity goes up with the market, not all of it, but you get up to a cap. We're going to use a cap of 6.5%. But you see when the market goes up, you get some of the gain. When the market crashes, you get none of the loss. You get a zero. You retain these gains over here that you had gotten from the first couple of years. And then when the market goes up again in these years, in the 2003, 4, 5, 6, 7, you got some of those gains. But when the market crashed over here, and as it will again, you didn't lose anything. So this is very good. It's very safe. We also call it sleep insurance because you know that you can't lose money. You get some of the market gain and you get none of the loss. That's how the basic annuity works. And this is how to look at the same idea but as a spreadsheet form. This is a person who would put a comparison between $100,000 put into the equity index annuity or an S&P fund, S&P 500 fund, on January 1st, 1999, and what it's worth on December 31st, 2010. You see that when the market went up in 99, 19.5%, you would have made $19,500 in your S&P fund, whereas in the annuity, you would have only made 6.5%. You could make up to the cap. But then in the next 3 years, the market went down, down, down. Your S&P fund would have gone down considerably, whereas you would have gotten a zero. You can't get any losses. The floor is zero in the annuity. And then when the market starts going up again, like we saw on the graph, you start making money, but you make money in the annuity also. And when the market crashes in 2008, you lost a lot of money in your market fund or wherever you were in the market, whereas the annuity you didn't lose anything. So at 12 years later, your 100,000 in the S&P fund is worth 105, basically where it started. And the annuity has 155,000. And that all is tax deferred, it's probate free, there's no annual fees, and you get 10% free withdrawal out of the account. Okay, so then again, that's the basic way that the annuity works. The income rider we're going to talk about gives you a guaranteed rate, and we're going to use a real example of a case I had. Tom had a 401k with $260,000. You can do this with a 401k, with an IRA, with non-qualified money. He had $260,000 in a 401k, and he wanted to maximize his income when he retired. He was 65. He was going to retire in about 5 years and want to start pulling out the money, or 6 years, and want to start pulling out the money. So what he did was he took $260,000, put it into the annuity with a 10% bonus. Some of the companies give you a 10% premium bonus when you open up the account, and then an 8% income rider. So his day one value is $286. That is $260 plus 10% is $26,000. So his day one value is $286. Okay, so this green account is what happens to his real money, is $286,000. It goes up with the market. When the market goes up, it gets up to the cap. When the market goes down, it gets nothing. So this is his account value, this green column here. So let's say at age 70, we're going to work with when he's age 70, he passes away. Okay, his kids get, or his spouse gets this money, this $345 here. Or if he needed to go to a nursing home, and you can take all the money out penalty free. If you need to go to a nursing home, he gets this $345. Okay, if he wanted to surrender the whole policy and pay whatever surrender charges there were at that point, he'd get this $345 because that's his real money. That's his money. But he also took the income rider, which gave him the $260 plus 10% bonus of $286, and that income rider gives him 8% every year. 308, 333, 360, 8%, 8%, 8% every year. When he's 70 years old, he's got $453,000 in his income-only account. Now I put this account in purple to differentiate. This is not his money. I've heard agents sell this or explain this and say you can get 8% on your money until you take the money out, and want to pull the money out in retirement. And that's not true. It's not your money. Don't get 8% on your money. Your money is this green account value. The 345 is your money. The 453 is a sort of a hypothetical figure, or just a calculated figure of how they're going to calculate your income value. So at age 70, Tom calls and says, I want to start taking income. They say, well, okay, you have $453,000 now in your income account. We're going to pay you at age 70. We published this number. We're going to pay you 5.5% of that 453, or $24,961 a year, and we're going to pay that to you for life. No matter how long you live, we're going to pay that $24,961. And the reason this is fantastic for Tom is because had he decided not to go with this annuity and not to go with this income rider, and he said, instead I'm just going to put the $260,000 in a CD, earning 3%, if you can find a 3% CD. But let's say he did, and he put $260,000 in a 3% CD. So after 6 years, 3%, 3%, 3%, he has $310,000 in his account. Not 345 like in the annuity, and not 453 like the income value in the income only or pension account value, but he has $310,000, and he wants to take out $25,000 a year just like he could have with the annuity, with the income rider. Well, that $24,961 or $25,000 a year is going to run out in 13 years, right? 12 years would be $300,000. Another year or year and a half, it's going to run out, and he'll have no money left. Whereas the annuity pays for life. Right? This $24,961, as he takes it every year, it comes out of the green account. It comes out of his real value. So every year, the green value is going to earn the credits that the index gives him, 6.5, 3, 6.5, 350, whatever it does, and then be diminished by the income rider that they're paying him, the income account, the $24,961. So after 13, 14, 15 years, this green column, his money will also be diminished or will be zero. But they need to keep on paying him, contractually obligated to pay him this $24,961 for the rest of his life if he lives to 150 years old. And so he knows he won't outlive his income. Whereas if he did it on his own, he would outlive his income. He would, in 13 years, unless he knew he was going to die before age 84 or 83 or 80, depending when he starts, he can't outlive this money. So it's a way to keep your money coming and knowing that you're going to have it no matter what. Just to point out also, if he had taken income when he was 75, so now there's 666 in the income account value. They pay 6%. That's 40,000. Again, it's going to come out of the 417 here, but no matter how low it goes, go to zero, the real account value, he still gets the 40 for life. The other thing to point out is if there's any money left in this account, in the real account value, the green value, when he passes away, let's say he takes this from age 70 to age 73, and then he passes away, the kids or his spouse will get this money. This is his real money. Okay, so it's a way to make sure you don't outlive your money, and it's a way to make sure you get more money than you would have had you just done it on your own. Because what Tom would have done over here is said, well, I only have $310,000. If I take 25 a year, I'm going to diminish it. So he'd really actually not take 25. He'd take much less. I want to show you one other way we use this, and that is to get extra money in retirement. This is a case based on a real case we had of Gloria, whereas this is her situation. Her assets were $105,000. She had in a CD, in a bank CD, earning 2%. So that's $2,100 a year, or $175,000 a month. Okay, it's a small amount of money, and worse off, Gloria's income needs were $1,700 a month. You know, she had her condo assessment, she had food, some clothing, some travel. She needed $1,700 a month. Her Social Security only gave her $1,100 a month, and as we know, that's not really going up. So she was short $600 every month. She was dipping into her account in the bank, and she was worried because her CD income only gives her $175 a month. She needs $600, so the CD income is not enough. So she came to us, and this is what we had her do. She decided to cash out the CD and hold out $5,000 for her use throughout the year, and transfer the $100,000 remaining into an annuity with a 10% bonus and an 8% income rider. All right, that gives her a 18.8% first-year return, or $118,800 in her income account. See that purple account like before? She has $118,800 when she's 79 years old in that account. At the end of the year, or when she turns age 80 the next year, she will begin getting 7% of that $118,800. That's the published number Like Tom at age 70 got 5.5. With this company at age 80, they pay 7% of the income-only account. 7% of 118 is 83.16 a year, or 693 per month for life, even if the cash account goes to zero. So you see that the CD versus the income rider, her CD was giving her 175 a month. The income rider, and it wasn't guaranteed, she's dipping into it. The income rider gives her 693 a month for life, and she was very happy about that because, as she said, so wow, I quadrupled my income for life with no risk. She was now able to have the income that she needed because of the income rider. Just to point out also that these companies these are A-rated companies we use, and they have mandatory reserve requirements, which mean that when a fixed annuity is purchased, the insurance company by law must have on hand dollar for dollar reserves to cover all anticipated payouts. So there's plenty of reserves in these companies to pay out all of their liabilities. If you want more information about this, about these income riders or our tax-free planning, please get in touch with me. Again, my name is Bill Cantor. My number is 847-674-6470, or my website, which is www.iwantoretireTaxfree.com or www.completeerp.com. Thanks a lot.